morning, Will.
I saw that in various notes of late you were calling for a correction, which obviously we had. We had a bit of a pullback, but was that it? I mean, it was brief. It lasted a week or so, 4% peak to trough fall, and we're back at records again.
Yeah, I mean, it was brief. So if you blinked, you missed it. That looks like that was it for now. I mean, the markets are quite powerful at the moment. I mean, and they have been, right? I mean, there's tremendous liquidity. There's a very good and very understandable story behind the scenes, meaning we've got a strong economic recovery that's visible to everyone. The earnings season's been good so far. We wrote about that this morning. And people have bought into it. I guess what I would say is that, right now the markets are, I think, still in a bit of a fragile state, more fragile than people might think, because people are involved. There is still leverage in the system. It's not, dangerous necessarily. And so we should expect these sort of 3 to 5% corrections at any moment. That's normal. But, yeah, the correction over the last couple of weeks is over. We made new highs, and the bull market is intact.
So who is the marginal kind of market mover at the moment? And is it the retail investor in a way that, let's say, 2 years ago we never would have expected? And what's the risk that they change their mindset and outlook?
Yeah, I think that's the right question, Wilf. I mean, right now we are seeing definitely inflows from the retail community, meaning we're seeing equity inflows for the first time in really a decade in a more consistent manner. So I would argue, and you just said it, that the retail community, the retail investor, is the marginal mover of stocks at the moment. They are coming in, and that's not a bad thing. However, I would point out consumer confidence has not really kept pace with that. So they could change their mind. Right now, they seem to be in a bullish mindset, and they're putting money in. So you're absolutely correct. Retail is the marginal buyer, and that's probably going to persist. If that changes, then we probably would have a bigger correction.
And so the other factor, maybe this applies more to the institutional buyer, not the retail buyer that we've talked about for a long time, has been yields rising and whether that pressures multiples. Where do you stand on the levels that start to worry you on that, given that, today we touched 2% again on the 30-year?
Yeah, I don't think it's a problem if it happens gradually. So, I mean, we know rates have been moving up over the last 4 or 5 months pretty steadily. And as you point out, 30-year now is about 2% for the first time in quite a while. 10-year has been kind of creeping higher. If that happens gradually, earnings should be able to offset that, meaning we can, markets can still move higher. And more importantly, individual stocks can move higher because they'll surprise on the upside further. The problem for the market will come if rates were to move up in a nonlinear fashion for some reason. All of a sudden, the bond market, says, oh, my goodness, there's too much stimulus now. Inflation is going to be a problem. And let's say the 10-year were to shoot up 50 basis points really quickly. In that case, you could have a 10% correction quite rapidly. But that's not happening. We've been a little surprised by that, quite frankly, that the bond market's been kind of dragging its feet in that regard. But right now, it's a gradual move higher. And if that's the case, then, these pullbacks are going to be brief and shallow.
Shepard Smith here. Thanks for watching CNBC on YouTube.